See, as per the each bank today is on a CBS server. Normally, the system is supposed to classify these things, classify the asset into performing or non-performing.
Non-performing. Standard or substandard.
Standard or substandard,
Yeah.
or doubtful, etc. But let us just think in terms of two things. Okay, Anjali is here also. So we'll quickly wind up. So basically, what you have to see is the classification done by the bank correct or not? That's all. And to see that, the best way to do is you get the statement of account and have a look at that aspect, whether the interest has been paid. Most important is the interest paid or not? If the interest is paid, most probably you'll find that the account will be okay. Because see, nowadays, these are times of stress.
Yes,
these are times.
Good
evening, Anjali. Welcome.
Good evening, sir.
Okay, so did you get a chance to look at last time's?
Yes, sir, I watched the recordings.
You watched the recordings. Now, any issues with that?
No.
So now, if I ask you to calculate NPV and IRR, you'll do it, na? Or you forgotten? Okay, doesn't matter. It's okay. So basically, so another thing I was saying is that these lectures that we have, since at the end of the 4 months, the Young Skilled India gives you a certificate that you understand the course properly, you have grasped whatever was there in the course. So for that, normally, we have to evaluate your performance. So how well you've understood things. So what I want to do is, once we finish, let's say, section-wise, once we are through with the finance section, so we finished 2 units. Once we finish this, the third and fourth unit also, I will basically, what I want to do is have a test. Now, for that test, we'll try to do it in 2 parts. So one part will be, it will be an objective thing. Like, for example, I can ask you MCQs, or I can give you, if not objective, very short answer questions. Whether I can give you a whole host of questions and you try to answer it and you send it back to me. So that can be one. And one component of the test can be in terms of something which you do at home, you prepare it and you send it back to me. So what I would very much appreciate is that once we are through with the let's say the whole finance part, it will take some time, at least 1 more month. So when we are through with that, then you must spare some time, all of you, for doing that assignment. That is necessary, and send it to me. So what I hope it will achieve is that it will give you a chance to go over the presentations again. And apart from that, it will also test your knowledge of and your understanding of the subject matter that we have covered so far. So now let's just start with today's section. So today what we're going to do is we'll be looking at 2 things. One, of course, is cost of capital, and just one thing which is sort of intertwined with this, or very basic to this, and that is the capital structure of a company. What is the capital structure of a company and how that impacts the cost of capital, and how do we calculate so for Lokesh, this is going to be a little, what shall I say, this should be very, very familiar ground for him, because this is his area of work. So wherever you think you can add something to the discussion, something which I have not covered, please do, Lokesh.
Okay.
It will be good for Anjali and it will be good for me also.
Okay.
Because you are approaching it as a professional. So that way it's good. I am approaching it as an academic. So, these are different vantage points. We are looking at it from different places. Okay, so I'll start with something which is, for you, this is absolutely dal roti, Lokesh, here. And for Anjali, I'm sure are aware of the balance sheet of a company. And this is a T-form balance sheet. So basically, this part, these two things which I have put here, these are the essential sources of long-term funds of a company. So the equity capital, basically this is, where does the company get its equity capital, Anjali? From?
Liability.
No, these are all liabilities. See, liabilities are basically any source of fund that the company has is a liability. So capital is a liability. Any borrowing which the company does is a liability. So where does the company get its equity capital?
From the people.
So
Investors.
From the investors. Okay. So what does the company give them in return?
Interest.
No. Shares.
Shares. Yes. Shares.
They will give them shares, na? So basically, let's say that the three of us, you, Lokesh, and myself, we own a company. And let's say that it's equally divided between us. So 33 and 1/3 shares are with each of us. And together it is 100% of the capital. Now what happens is, suppose we want to take this and open this up to the public, let everybody become a shareholder. So basically what will happen is, we will reduce our share in the company and sell it to people who will become fresh shareholders. So these fresh shareholders who are given shares by the company, so it may be 100 rupee shares, it may be 10 rupee shares. The face value of the share is not very relevant here. Whatever is the face value of the share, the number of shares given to the person will be in proportion to that. And all the shares which you give to them, if you add them all up, the amount of money you receive, that will be your equity capital. See, equity is basically, it means that this belongs to you. So the point in equity capital is that the most, the important thing to remember in equity capital is that there is no obligation for the company to return that money. See, you are expecting the company to do well. You are expecting to earn money on those shares. You are expecting to get dividends, but there is no legal obligation on the company to actually pay you dividends or to return the money to you, because you are an owner. You are a small owner of the company. That is to be remembered. So that is one. Second thing is that you have equity capital, but you still need more money. So you borrow. Now the borrowing that you do can be directly from the public. If you borrow directly from the public, you will do it through a bond or a debenture. For our purpose, we will think of both as the same, the bond and the debenture, in the sense that it represents a debt for the company and it is payable in a fixed period of time. So it could be a 5-year bond, it could be a 6-year bond, 7-year bond, 10-year bond. After that period is over, whoever has invested in the bond, that person will get his money back. And in between, the company will pay interest. So the difference in the bond and the and the borrowing, the long-term borrowing like a bond and the capital is essentially this, that in the case of a long-term borrowing, the company will actually return the money along with interest. In the case of capital, the company receives the money in good faith, expects to pay dividends, but there is no obligation on the company to return that money as long as the company is functioning. The moment the company stops functioning, it goes into liquidation. At that point of time, of course, all the assets of the company will get sold, and that will be divided between everybody from whom the company had taken money. Is this point clear? Okay. Now, there are other liabilities which are short-term liabilities, which we need not discuss in detail right now. Broadly speaking, if you just look at this box here, the long-term and capital, and the box here, the basic difference is that current liabilities have to be paid within 1 year. So whatever these are, 1 year is the maximum, but essentially speaking, these would be payable in months or sometimes even in days. Take a simple thing. People are working for you. You expect to pay them salary at the end of the month. So at any point of time, the longest this would be outstanding would probably be 1 month. Or interest payable. The bank would expect you to pay interest on a loan taken from the bank every month. So that again is something which is every month. Rent is paid every month. Dividend payable is something different. Let's leave this part of it out. It would refer to a payment of dividend which has not been made, but it will be paid shortly. So that is there. The assets, once the company gets these things, what does the company do? It invests it in firstly, the fixed assets, land and building, machinery, office equipment, furniture. These are simple examples. And to actually, it can also make investments in other companies. And the other aspect would be the current assets, in the sense that this represents the actual working of the company. If it produces something, it buys raw materials, it processes that raw material, it produces finished goods. So all that is reflected here in the inventory. It could be making credit sales, in which case it would reflect here in the bills receivable. And there could be some tax refunds which the company is expecting, in which case, Lokesh's firm would locate such refunds for the company, and that would become a tax receivable. How often does this happen, Lokesh? This tax receivable, refund receivables for companies?
So depends on case to case, sir. 3 months to 1 year.
3 months to 1 year. But it happens, na?
Yes, sir.
It happens. And why does it happen? That for Anjali's benefit here.
Sir, you want me to say why it is late, sir?
What I want to understand is, like when a company overpays, it pays extra, and for some reason it has to get back a refund from the income tax department. So does it miscalculate its taxes? What exactly happens?
It's not about miscalculation. Okay. On an average basis, it collects TDS on average basis. It's a fixed percentage on monthly basis. At the time of filing of return, we will make an assessment of the company. At that time, as per the provisions, we can claim some deductions because of the investments made before end of the financial year. That is before the end of the March 31st. In that case, you might have deducted extra TDS. So you can claim that extra TDS by filing an income tax return. So that difference amount between actually deducted TDS and tax liability is the tax refund receivable.
Great. Thank you, Lokesh. Anjali, I think that gives you an idea. See, the company is making advance tax payments. Every month, it is making a certain advance tax payment to the income tax department on an average basis. It is expecting to get a certain amount of income. On that basis, every month, it is making a payment. But if it overpays, then when the income tax return of that company is filed, it gets back a refund. So the main takeaway here is to remember this, that this is the capital which the company has got, and these are the long-term borrowings. Now, let's So what is capital structure? This is something which you're well aware. It is the proportion of equity and debt in the total capital of the company. Now, remember, these are the only two ways of obtaining capital for the company. You either will get it by giving shares to someone and making those people part owners of the company, or you are going to borrow money. So you could borrow money, like I said, from a bondholder, or maybe you could borrow money from a bank or a financial institution, depending on which is better for you. Who decides how much of what this capital structure is going to be? The board of the company is going to decide. Because as we discuss this further, you will begin to realize that one major issue to be looked at here is the cost. Both of these have a cost. The equity has a cost, the debt has a cost. The cost of the debt is a very clear thing. It's stated at the time you take the debt. You take a loan from a bank, the bank tells you very clearly that, look, this is the rate of interest that we propose to charge. 10%, 12%, 11%, whatever it is. If you issue a bond, you tell the bondholder that, look, this is the interest which we propose to give you. So the debt part is very clear. The other side, the equity part, is something which we will see today. There are ways of calculating it, but you can never be absolutely certain that that will be the cost. But one thing you can assume, that equity will, in the long run, be costlier than debt. That point, we should remember this always. Why will it be costlier than debt? Because remember, the higher the risk, the higher the return. An equity shareholder, remember we said that the company is under no obligation to return his capital to return the value of his shares to. The company is under no obligation to give him dividends. And if, in the unfortunate instance of the company failing and going into liquidation, then in that case, if the assets are sold, even then the rights of the equity holder to get a portion of that, the proceeds of the sales, come at the end. First, the creditors have to be satisfied. So the bank and the other, the bondholders, those people are going to first come. Any current liability payments there, those guys are going to come. So that is why everything has a cost, and the board has to make a decision here about what is the proper capital structure that the company should have. Now, so I have just fleshed these out a little more clearly. You suppose a loan is taken, it's a known thing what the cost is going to be. But if I, let's say, raise 200 crores through equity, the shareholder has a right to expect something more than what you would actually give to the banker. Why? Because he takes much higher risk. So one way of, like just for the sake of clarity here, let us assume that if a bank charges 12%, a shareholder, considering the huge risks that he has, would expect at least 20%. I'm not making a calculation here. I'm just giving you something that maybe he's expecting 20% because if he invests it in some other company, he might get a 20% return there. So that opportunity cost principle will probably push him to demand 20% from you also. If not demand, at least to expect that money from you. Now, if the cost of debt is 12% and the cost of equity is 20%, what is the cost of capital? Suppose I ask you this question. Is it possible to answer it on the basis of this information alone?
Sir, it's not possible.
Not possible, no? Anjali, you see the problem here. If I tell you that the cost of debt is 12 and the cost of equity is 20%, can you actually answer this question then? Do you have sufficient information to answer the question, what is the cost of capital, or do you need some more?
I guess we need some more information.
You would need to know the proportion of equity and the proportion of debt, because the amount, the cost is going to depend on the proportion. Okay, so the information is insufficient to provide an answer. Now, what we'll do is we will look at two balance sheets. These are taken from moneycontrol.com. This is the NTPC. And if you look at this, the NTPC company, what you'll see is the total share capital is 9,696 crores. This figure here. This is the March 21 figure. So Money Controls gives you figures for a fairly large period. I chose 5. So let me take 5, 17 to 21. So as you can see, during this period, the capital has increased from 8,245 in March 17 to 9,696 in March 21. Reserves and surplus are 1,09,288. Anjali, what could this be? This reserves and surplus?
These are the capitals, no?
Look, the capital is here. This is the share part.
Total share capital.
So the total share capital is this. So essentially, members of the public, the government, all of us have contributed to this. So if you hold an NTPC share, you're also sort of included in this. What is this?
Reserves and surplus.
This? Reserves
and surplus.
So what are reserves and surplus?
Revenue?
No. Not revenue. So look at the difference here. This is 9,696. This is 1,09,000. So total shareholder funds, when you add, it's 1,18,000. This 1,18,000 is the company's own money. So one thing which you know immediately is that this is not borrowed from anyone. This is something which the company has earned over the years. See, look at this. Look at 17. What was this figure in 17?
87,000.
87,000. It went up to 93 in 18.
97.
Then 103.
103 and 109.
And then 109.
Nice.
So basically what you see is, why is this increasing every year? Every year the company is making some profits.
Yes, sir.
And some of those profits are being kept within the company. So some of the profits would be going as dividends to the shareholders, but some amount of the profit is being retained within the company, and that is increasing its reserves and surplus. So that means from the time NTPC became a company, from that time till March 21, it had accumulated profits of this amount. Lokesh, anything to add to that?
Of course, sir, securities premium like that.
Once again?
Premium, sir. It can contain a premium on sale of premium on shares. Sir.
Premium on sale of shares.
Shares.
Okay.
It may be at the time of buyback or first issue of shares. It might be generally, as of now, you told that NTPC. For example, NTPC face value of share is 1 rupee, but it is now trading at nearly 130, 140 rupees. Yes. At the time of first issue, it must have been for at least 100 rupees.
Yes.
The difference of 1 rupee and 100 rupee, 99 rupees is the premium.
Will also come here.
Yes, sir.
So did you get that? Thank you, Lokesh. Did you get that, Anjali? So
yes, sir.
When shares are sold, they are sold above their face value.
Yes.
To the public. So whatever is the difference. So if the company is doing well, it's sold at a premium above the face value, and if it is that premium amount will also figure here. So it's generally, if you want to break down the reserves, this is what a share premium reserve, if I'm not mistaken.
Yes, yes.
So this is NTPC. So what you see here is, now look at the debt component. The long-term borrowings are 1,05,000 51,000 crores. That means NTPC has borrowed a huge amount of money from different institutions, from the public, through bonds, through loans. All that is coming here. So this is one company dealing in, let's say, a public utility, power, and this is the structure of its capital. Now, if you want to look at the difference between equity and debt, you would basically be dividing these two figures. And you would get an idea about the debt equity ratio, the proportion. Now, this is another balance sheet of another company, which is a capital intensive company, Tata Motors.
There is not debt.
No, you'll see the debt here again, 16,000 crores. So you can see debt is 16,000 crores. They began with a capital of whatever. In March 21, the capital is 765 crores. By this time, reserves have reached 18,000 crores. So their total shareholder funds coming to 19,000 crores. Their long-term borrowings are 16,000 crores. So see, the company manufacturing, let's say, cars and trucks and things like that, such a company would have, it requires a lot of investment to put together the assembly lines, the factories, and the entire manufacturing process for these different vehicles. So Tata Motors here required a fairly large amount of debt to do this. So if you look at this, initial capital is low. Their debt, as you can see, is a little less than the total profits that they have. Now, if you look at, so public utility companies with definite sources of revenue will generally have high debt and low capital. You can take this in the case of NTPC. Capital intensive companies like automobile companies will have high debt and low capital. These companies generally have stable revenue sources from which debt repayments can be made. That is one of the crucial things. In fact, whether a company is in a position to pay its debt or not, for Lokesh, it will be of interest because he needs to know whether it can pay back its bankers. In which case, it will decide whether their loans from the bank are going to remain performing or substandard. So that is another thing. Now, I took two other companies. Which are basically service companies, just to bring out the difference in the debt figure. So now, if you look at this, this is Infosys, if I'm not mistaken. Yes, this is Infosys. Now, you look at this, their equity capital is 2,130. Total shareholders' funds, including the reserves and surplus, becomes 71,531. Long-term borrowings is zero. It's very interesting here. Long-term borrowings is zero. They don't need to borrow at all. And one of the reasons for that is the main investment for these guys, the main assets for the Infosys people are essentially the human resources that they have and the software that they have. So they don't have to build huge establishments in terms of, like manufacturing facilities and things like that. Every person sitting there is actually manufacturing a service or helping to provide a service which has been conceived by the company as a whole. So these guys need very little debt. So you can see the very clear difference in the capital structure here. So it is entirely equity, 100% equity, debt is not there. Now, another company, Tata Consultancy Services, also in the same business of software, of providing consultancy services. So once again, the big asset here are the human resources. They make the software, they conceive the different solutions to problems, And all that is done by human capital. As a result of that, here again, we find that debt is actually zero. Whereas the initial capital they brought is also very, let's say, less as compared with the other company which we saw, Infosys, half that in fact, 370 crores here, which again, if you look at March 17, was only 197, gone up to 370 here. Over its life, it has managed to accumulate reserves of 74,000 crores and total shareholder funds, which in fact are the total long-term funds which this company has, are 74,794 crores. It does not have debt at all. So this is another company which believes in not taking debt, mainly because it is very comfortably placed as far as capital is concerned. Okay. Any questions, Anjali, here? Is this okay? You can see now, the basic point I was trying to make here is that these different companies have different capital structures. And what is creating this difference? It is the type of assets that they have, the type of revenues that they have. So those two things are essentially, so they need to invest less in capital assets. Therefore, they don't need to have a huge amounts of debt. Okay. So service companies with low capital investment and tech companies will generally have a high equity and low debt or even no debt. So here we took these two cases. Now, let's just look at a very simple calculation of the cost of capital. Lokesh, this is going to be very, very boring for you, but you will have to bear with us for this. So I'm taking a company here, company A. It has assumed that it has 2,000 crores just for the sake of a figure of capital. The cost of this is 20%. So it's paying dividend. So the cost will work out to 400. It has loans from banks and it's paying interest at the rate of 12%. And the 12% interest it's paying, so on a 1,000 crore loan, it's, let's say, working out to 120. I've kept it very simple, no compounding, no problems. Total capital which it has or total funds that it has are 3,000 crores, and the total amount of the cost which it has for this is 400 plus 120. So the bulk of it is for the equity and 120 for the debt, gives it 520. So the cost of capital here is 520 divided by 3,000. So they have an 18% cost. Okay. Considering this is the 18% cost. Why is it 18%? Mainly because a large part of the funds are coming from high cost equity. Clear, Anjali? Okay. Company B. Now, company B, let's say they have the same cost structure, but what they have done is they have opted to have a higher amount of debt and a lower amount of loans. Now, see, what happens is if you make this 1,000 and you say that it's 20%, the amount of dividends you pay will be 200. So your cost is 200. Loans, since it's 2,000, 12% is the cost. The amount of interest you pay is 240. The total cost for you for the funds that you have are 440. What is the total cost of funds? 440 divided by the total funds that you have. So the cost of capital becomes 16%. So one very simple takeaway from this is, if I go for debt, I can actually reduce the cost of capital. This is one takeaway. Now, the capital structure here is 67% equity, 33% debt. Here it is reverse. So here my equity is 33 and debt is 67. In this case, my cost of capital was 18%. Here my cost of capital is 16%. Okay, so that's one takeaway. Now, another thing you remember when we speak of cost of capital, generally we are speaking in terms of the weighted average cost. So this actually, when you calculate the actual amount here of interest which you pay on 2,000, this is taking care of the weight. So in the the total funds of 3,000, the weight of capital is higher, no? Because it's 67% weightage is coming from equity. So that is automatically taken care of if you do the actual interest or dividend calculation and you add it up like that. So just remember, when we speak of weighted average cost of capital, we are just considering the weight each component of capital has in the total funds that the company has at its disposal. Now, let's take this. This time, what we'll do is we will also include the tax component. So we're getting into loquacious territory here again. If we include the tax component, see what happens. In the first case, company A, the total funds it has is 3,000. Let's say the profit before interest and tax is 500. And for company B also, with a different capital structure, but ultimately with the same amount of funds at its disposal. 3,000 crores in both cases. Let's say both end up with the same amount of profit before interest and tax. Now, the interest component here is 120 because it has a smaller amount of loans. The interest here is 240. So basically what happens is profit after interest becomes 380. Here the profit becomes 240. For tax, here, assuming, I think I assumed the 40%, 40 or 45% rate. Here, as you can see, because in this particular case, the debt was less, the tax tended to be higher. Here, the debt was more, so tax tended to be lower. So, profit after tax here is higher, but they get a return of only 10%. But in the case of company B, even though the profit after tax is lower than company A, the actual return they've got is 14%. And why has this happened? Mainly because they have managed to get the benefit of tax. So what are the takeaways for you? Interest is an expense for the company. And expenses are always deducted from the income to arrive at profit. So what is actually taxed? Profit after interest. So interest becomes a deductible. If interest is higher, then the company will generally be paying more taxes. And I'm sorry, if the interest is higher, the company will end up paying less taxes. That's the point. I think I made a mistake in writing it here. Okay, then the shareholders of the company are getting a higher return with a smaller investment. See, the basic thing to remember here is these shareholders, the total amount of capital they contributed to the total funds of the company is half of company A's, in the case of these shareholders here in company B, but they get a higher return with a smaller investment. Why? Because they are using other people's funds. And over a period of time, the debt will be repaid. See, if the company is doing well, if its revenue sources are good and stable, over a period of time, it will pay its debt. And if it pays its debt, then at the end of the day, it will not have debt at all, and its profits are going to increase. So that's one thing to remember there. Now, see, here I'm taking the same example again. Two companies with different capital structures. Both companies begin with an equity capital of 2,000 crores. The first one takes loans of 1,000 and has total funds at its disposal 3,000. It earns a profit of 500, profit before interest and tax of 500. The other company decides to leverage its equity to a larger extent, much larger extent, takes loans of 4,000, 4 times its equity, ends up with a total fund of 6,000, is able to do so much more business, ends up with a profit before interest and tax of 1,000, pays more interest, but at the end of the day, it ends up with a profit after tax, a profit after interest, which is higher than company A. So here, both the shareholders of A and B have both contributed the same amount of capital. But by using more debt, this company has been able to earn a much higher profit. And ultimately, what you can see is that the profit after tax here for company B is 286. This is 209. And more importantly, the return on capital is 14.3% for company B and only 10% for company A. So basically, this is the advantage of using debt. Only problem is that when you use debt, there is a financial risk that you undergo, because if you are unable to pay the debt, what will happen is that people are going to take you to court, and if you lose, and if you are still unable to pay, your company can become bankrupt. So there is a huge risk that side. But if you're sure about your revenue streams, if you're sure about, if you know that you'll regularly be able to make sales and earn profits, then debt is generally a good way of utilizing the reputation the company has and earn much more money. Okay. Is that clear, this part?
Yes, sir.
Now, so the next point we come to here is the opportunity cost of capital. Remember when we were discussing opportunity cost, how did we define opportunity cost, or what did we? What's the simple way of understanding opportunity cost?
The next best alternative.
The next best alternative. So somebody who's, let's say, investing in the shares of a company, his opportunity cost would be the amount he would have earned if he had invested in another company. Remember, in opportunity cost, you always have to consider investments with the same level of risk. You can't compare investments with different risks, because investments with different risks will naturally have different rates of return. But assuming that I am investing in this particular company, but if I invest in another company, I'm going to get 10%, then my opportunity cost is 10%. I would be expecting to get more than what I'll get in another company when I invest in this company. So the first principle here is, the more the risk, the higher the required rate of return. So the project's cost of capital is the minimum required rate of return on funds committed to the project. You begin here. You're committing certain funds to the project. The minimum required rate of returns has to be at least you have to earn at least as much as your cost of capital. The minimum rate of return depends on the riskiness of the project. It goes without saying. Each project that a company undertakes will have a different level of risk, and the cost of capital will depend on the risk. So where a company undertakes multiple projects, different types of projects. So for example, think of, to go back to the example we used a few lectures back, of Tata Motors making nano, Tata Motors also making, let's say, electric cars, and Tata Motors making its standard, let's say, take the zest. It's the equivalent of the desire. If you take these cars, the levels of risk are also different. Each project has a different level. Why? Because Nano was an absolutely new vehicle, higher risk. Now, who is taking the risk? Basically, the investor. The investor and the creditor also. But right now, we are focusing on the investors here. Now, the investor has choices. His decision depends on how much risk he is prepared to take. If the risk is high, he will expect to earn a higher return. When is the risk high? When there is uncertainty about the future returns of the project. This is the basic thing here. So if something new is being tried, something which is not there in the market, you can expect the uncertainty to be higher, in which case an investor would generally want higher returns as compared with an investment in a stable project, something which is very well known. So let's have project 1. What is project 1? There is an existing market for the product. There are buyers for your product. The company has modern technology that can produce at lower cost with better designs, more features. So the product it is selling already has a market. And this company has managed to get better technology. It can now produce good designs at a lower cost. The product which the company has, let's say, more features than the other substitutes available in the market. So this, let's say, is one project. Another one would be, company wants to produce a new product. The market has to be developed for the product. It's not known whether consumers will like the product or not known whether the price will be acceptable. The potential size of the market is not known. So there are lots of unknowns in this project. So it goes without saying that the risk is going to be higher in project 2 as compared with project 1. If the risk is higher in project 2, and now you want to go for, let's say, an issue of equity shares, only people who are going to expect a very high return are going to come to you. Because people who would be satisfied with a lower return would be happy to go for a project of project 1 type, where the things are known, there is much less uncertainty. Even if the company goes for bonds, suppose the company, project 2 type company and project 1 type company both decide to actually use bond as a way of raising funds. And they say that we will issue bonds, people can come and buy bonds. This project 2, this company will, the company here doing project 2 is going to have to offer a higher rate of interest on that bond or a higher coupon on that bond than it would have had to offer for project 1, mainly because the risk here is higher. Okay. Is this clear, this point? Okay. Now, let's take, so what I did was, I just took this simple case of arranging, these three, there are 3 examples here. The first one is, company wants to produce a product for which there is already a market. The first case which I took, project 1. So the risk is less. Second case, our project 2 would be higher, on a scale of risk, it would be higher than A. So less risk, high risk, it's appearing to the right of A at a higher level. And what is happening here is, the risk is higher, so the expectation of return is also going to be higher. So low returns here, higher returns here. If I have a third project, a newly invented digital product that has never been tried before, acceptance of the product by consumers is not known. In this particular case, the risk is huge. So basically what will happen is that the return expected here is going to be higher. Now, tell me one thing. Will a bank finance product, let's say a bank, would it be willing to give loans to the company for this project here, project A.
Yes, sir.
Yes, sir.
Ah,
The
Bank.
lower risk and regular operations.
right. So both of you immediately feel, yes, it's safe for the bank to give here. Now, suppose we come to this one. What do you think will happen here?
It will give, sir, but it adds on risk premium or something.
Yes.
So
Okay.
risk premium
Anjali, clear?
increases.
So in the project B, the bank will not will to give the loan.
Or it will demand higher interest.
Yeah, it will demand
It can
higher.
demand higher interest. It can say, give me more collateral, secure me in some other way. And but then I can maybe finance. Now come to the one which has the highest risk here. What will happen here? Who will finance this?
Only venture capitalists will finance it. No bank.
Anjali, Lokesh says that only venture capitalists will actually finance this one. You know, this newly invented digital product. So
Even I believe,
you agree?
the third project, no bank is gonna invest.
Bank will invest,
Not invest.
not invest. Okay, so where will this guy get the money? So essentially, what will happen here is somebody has to take a huge risk. Also, because there may be a fairly long period after which this company will be able to earn revenue, after which the value of the company will increase. And the only people who take risks of that kind are to be found in the venture capital industry, angel investors, venture capitalists. So these people, what is their incentive to take this high risk?
They offer they will charge a very high rate of interest, sir.
No, no, it's capital, Lokesh.
Sir,
No interest.
sorry, they will provide capital, but they will ask for share in the project, and
Okay.
they because they expect the project will be good, so they will ask for share and expect good returns in future.
So see the whole suppose you take the case of Facebook. Or no,
Yes,
let's
sir.
not take Facebook. Let's take Flipkart. So when the Bansal brothers wanted to get capital, they had their business model. They wanted to start. So they go to the venture capitalist. So the basic negotiation which takes place between the Flipkart people and the venture capitalist is essentially about the amount of stake the venture capitalist will demand for his capital. So a venture capitalist will naturally want a huge stake. So he may say, you give me 40%, 45%, that is going to be my stake in your company. Tomorrow, if you are a success, and if you go for, let's say, an IPO, then at that point of time, 45% of the shares will be mine. So I will get a huge payday when that happens. So basically, in this particular case, the returns can be literally astronomical, can be huge.
Yes,
But then look at the risk side. The
maybe
risk,
100% also.
but the risk is huge also. Because if for some reason that product doesn't take off, see, for every Flipkart, for every Amazon, there are 100 other products which were there, 100 other business models for digital products which failed. So think of the venture capitalists who had actually invested in those products. What would happen to them? They have lost their money. But normally venture capitalists are very rich individuals. So they have the capacity to take risks of that nature. And if at all they lose the money, it doesn't really impact their lifestyle or anything. Everything continues. They just sort of write it off as a bad choice and then hope they can get something better. So the required rate of return by the investor becomes the cost of capital for the project. So in this particular case, if let's say the guy goes to a venture capitalist and the venture capitalist takes a 40% stake in the company, and later on, when the company is in a position to pay dividends, and let's say he still retains that stake, he'll be expecting a huge return of 25-30% by way of dividends. So essentially, the point we've made out here is, if there is a clear risk return matrix here, you can very clearly see that as the risk increases, the returns demanded will also increase. And in the extreme cases of VCs, they will be expecting returns in terms of huge stakes in the company. Okay. Now, let's take the cost of capital for the company as a whole. So a company may have many projects. Some have medium risk, some may be high risk projects. So when this is mainly for Anjali's benefit here, Lokesh, I'm sure, is more than well aware of this. So essentially, the cost of capital for the company is the average cost of capital for each of its projects. The assumption I'm making here is that the risk for each project is different. So the cost of capital for each of the projects is also different. So let's say there's project A, investment of 100 crores, cost of capital is 14%. Another 100 crore investment, project B, it's riskier, cost of capital is 16%. Project C, it's even higher risk, cost of capital is 21%. So if you were to sort of want to know what is the actual average cost of capital for the company, assuming that they don't have any debt, if these are the only costs that they have, then basically, even if it's debt, it doesn't matter. You can consider this 14% as including the debt. So the cost of company capital would be essentially this divided by 3. I've made it convenient by having equal investments in each project. So basically, the point I'm trying to make here is that a company may have its fingers in different pies. It may have its hands in different projects, some which are average risk, some which are high risk. And depending on that, the cost of capital of the company is going to be an average of the cost of each of the 3 projects, which is also like saying it's an average of the risks that were taken by the company. Now, our next point is the cost of capital being critical for taking financial decisions. So this cost of capital discussion that we've had so far, why is it critical for taking financial decisions? Let's just discuss that. So the first thing which it is critical for is evaluating investment decisions. First decision is, see, when a company invests, the first thing it has is, should I invest or should I not invest? If I invest, then I have to earn a rate of return that is higher than the cost of my capital. Otherwise, I'm going to be in a loss always. And in fact, I've read a number of analysis on major companies in India, which are there listed in our stock exchange and everything, where even after years of business, they still run or get a rate of return which is less than their cost of capital. The people who do these analysis, their feeling is that in the early years, capital has been drained from the company. You'll find this interesting, Yogesh, because there are a number of commentators, experts who speak about this, and they say that a large number of companies, prominent companies in India, still have rates of return which are lower than their cost of capital. So effectively, they are making a loss. Now, in our example, project A has a cost of capital of 14%. The company will go ahead with this project if the rate of return is expected more than 14%. So this is expected. If you don't do this, it doesn't really make any sense. And how do I calculate initially when I'm making the investment? How do I calculate? I use one of the ways of doing it is I use NPV and the IRR, which we discussed. So if I can find out from my NPV and IRR whether my actual rate is higher than 14, then I can safely invest in that project. If it is not, then of course, I will reject the decision. So one of the the major importances of cost of capital is that it gives you that minimum rate of return which you need to earn if you want to make that investment. So it's critical in that way. The second is it will help you to take decisions about debt. So interest on debt is tax deductible, as we saw. And we also saw that interest cost reduces the overall cost of capital. So maybe you want to get the proportion between equity and debt correct. This is another thing, because this is going to have an implication on the actual cost of debt which you have. On the other hand, debt increases the financial risk of the firm. This one is critical. So the capital structure decision aims at maximizing the value of the firm while minimizing the overall cost. So I gave you one example, very optimistic case, where a company had equity capital of 1,000, took a debt of 4,000, and was able to do very well with that amount of money and earned a higher return than the company which was not using debt. So that is a best case scenario which is there. One bad, let's say, scenario is, so I'm sitting in this private hill station called Lavasa, which was floated by Lavasa Corporation. And this particular company was unable to make a success of this venture. There were 17, 18 bankers who had given loans for Lavasa. And as a result of that, these bankers, they took the company Lavasa Corporation to court, the National Company Law Tribunal. And the result is that Lavasa has now been sold. It has been sold to some new party. A new person has entered. And obviously, this person has bought Lavasa for a much, much lower cost than it's worth. Who has lost? The company. So that particular company has practically ceased to exist. Its investors have practically lost all their money. Like we said, there is no obligation. The risk which the investor in equity takes is total risk. If the venture fails, then the money is gone. So that has actually happened here. So taking these decisions about debt, this is crucial. Finally, see, it is an index for assessing or making a performance appraisal of the management of the company. So evaluating the performance of the top management. So how do I actually evaluate? If I find that the rate of return on the investments that the company is making is actually higher than the cost of capital, then in that case, I can say that yes, the management has taken a good decision because the wealth of the company has increased. Remember the wealth maximization principle. So I make investments which ultimately result in my wealth increasing. So if I find that as a result of a decision of the management, the wealth of the company has increased, then I can safely say that yes, I can give them a good performance appraisal and I can say yes, the management is doing a good job. On the other hand, if I find that like these companies which I refer to, who have after so many years of being in the business, they still end up with a rate of return which is lower than their cost of capital, then how would you rate the management? So, this whole cost of capital thing is a very good, index of the performance of the management. So you evaluate their investment decisions, you take the decisions with regard to debt and their overall performance. So that is something about the importance about the cost of capital. Now we come to our next point here, which is a point which I've made before. This was actually basically done so that to reiterate the point that interest is essentially a tax deductible. This means that the company pays less taxes if it borrows, as interest is deducted from the reduced, not from the profit. Actually, I don't think I should put it that way, because interest actually, because of the interest, the amount of tax which you pay is less. So that is one. So suppose cost of debt before tax is 15%, taxes are 45%. Since interest paid is deductible, adjusted rate will be lower than 15%. So the actual cost of debt is going to be 15, much less than 15, because of the fact that taxes are 45%. How do I calculate that? So 0.15 multiplied by 1 minus 0.45. If you do the calculation, you end up with 8.25. So as a result of the taxes, the cost of debt actually goes down substantially. Just a small calculation, something which I'm sure you've understood by now. So this was one point which I just thought I'd reiterate. And who pays that extra? So we can say the government is paying part of our interest, by giving us a relief on the, by not charging, let's say, taxes on the interest component. So okay, that's one. Finally, a simple calculation on the weighted average cost of capital. So suppose the cost of funds for a company are as follows: 10 crores equity at the rate of 15%, 5 crores debt at the rate of 7%. Now, what is this? What is the simple average cost of funds? If you just take it simply, it will just be 15 plus 7 divided by 2, 11%. What is the weighted average cost here? Why I wrote this, even though this is, absolutely unnecessary, is so that, sometimes you understand something better if you see it in contrast to its opposite. So the opposite of weighted average cost of funds would be the simple average. That's why I thought we put it like this. So if we calculate it without considering the weight, we would say that the cost is 11%. But if I calculate it with the weight, then I would say that the cost is very different. It comes to 12.35%. Why? Because the share of the equity is more than debt. And as a result of that, the actual cost goes up. However, I calculated it, I've taken the rate of interest and multiplied by the weight. The weight is basically 10 over 15, 10 over the total. The weight of debt would be 5 over 15. So the weight of equity is 0.67 multiplied by the rate of interest, you get 10.05. Weight of debt is 33% multiplied by the cost of debt, which we say is 7, you get 2.3%. If you add this together, you end up with a weighted average cost of capital of 12.35%. Now, if I factor in tax into this calculation, then I would get an even lower rate. So suppose tax is 40%, cost of debt 7% would actually come down to 4.2%, in which case the weighted average, the weighted after-tax cost of debt would be the weight of the debt 0.33 multiplied by the post-tax rate of debt, which is 4.2. So it's 1.38. And the weighted average cost of capital would now be 10.05 equity cost plus 1.38 debt cost. You actually end up with 11.43, which you can see is lower than 12.35, which was done without considering the tax. So essentially, these are just ways of emphasizing that when in capital structure, you have to always remember that debt can substantially reduce the cost of capital. That is the point which I have repeatedly made here. Now we'll come to the cost of equity. So we'll take a short break out here while I get my breath back, and so you guys also get a chance to maybe just chill for a little while, and then I'll be back in 5 minutes.
Okay.
Okay, Lokesh, just send a message to Anjali to join.
She's here, sir.
She's here. So basically, now we were looking at cost of capital. So we've looked at cost of debt. We've looked at the implications of tax. So that is done. Now what we're going to look at is the cost of equity. So I'm beginning with the simpler one, cost of preference shares. Now, like I said, remember in the case of shares, including preference shares, there is no legal binding on the company to pay dividend. So I'll ask Lokesh to just tell us a little about why it is called a preference share. Lokesh?
Sir, it is in terms and conditions, most of the cases, most of the points equal to equity shares, but there is no obligation to pay dividend. At the time of liquidation, these shares are paid once the outside liabilities are cleared. First, these preference shares are paid, sir. Okay.
Okay.
And they may not have voting right in the general meeting officer.
And I think in many cases, there is another benefit which they also get, that if at all dividend is paid, they get dividend first.
Yes, sir. If at all dividend is paid, first they will be paid, and the next equity shares will be paid.
Then the equity shareholders will be paid. And the big one is, if the company goes into liquidation and the assets have to be sold, then the claims of the preference shareholders will have to be satisfied first. After the outside debtors are done, outside liabilities are taken care of, these guys will have to be done, and only after that will the equity shareholders be paid. So this is one part. Then, even though it is not legally binding on the company to pay dividends to preference shareholders or to shareholders in general, it is generally paid by the company. Why would the company want to pay dividends if it is not legally binding? Any thoughts, Anjali? So why would a company want to pay dividends if it is not a legal necessity? You can't, shareholder can't say, why didn't you pay? Even then, the company would obviously prefer to pay and consider, the payment of dividend to be more or less a compulsion. Why is that?
To maintain the status.
To
maintain the status of the company.
Okay, reputation. You mean the reputation of the company? Yes, you're absolutely right. So non-payment of dividend is bad for the reputation of the company. That is one. This is a different point. If there is somewhere, if these preference shareholders, if there is a condition that they have to be paid cumulatively, then ultimately they'll have to be paid. And if dividends are not paid, the market value of the equity shares of the company can be affected. They will lose value. Because, when the market value of the company is assessed, at that point of time, it becomes necessary to, they look at the dividend paying capacity of the company. And if it is not paying dividend, what is it doing with that? See that if you don't pay the dividend, that amount is going to go into your reserves and surplus. So are you actually using that reserves and surplus, in a way where it's actually beneficial? See, the only reason not to pay dividend is that I am retaining this within the company with the intention of using it for the development of the company. And if I use it for the development of the company, then in the long run, the company is going to have greater growth and I will give you even greater dividends. So you wait a little, you'll earn more. Don't make me pay you right now. Let me take the money which I would have paid you in case dividend is not being paid. Let me invest it in the company. take advantage of business opportunities which are there. And as a result of that, what will happen is in the long run, I'll end up giving you much more. So that's one point. And so the good practice is always to pay dividends. Now, there is something called an irredeemable preference share. So in the case of financial institutions like banks and all, if quite often you have irredeemable debt. So this is similar, irredeemable preference share. It is never redeemed. This is something where the dividends will be paid in perpetuity. So as long as that company actually exists, the dividend will be paid. Now, in that case, there is a very simple formula for calculating the cost of a perpetuity. A perpetuity is essentially when interest on your capital or dividend on your capital is paid to you for life. That is the case. In the case of banks, even in the case of debt, where like bonds have been issued, they are quite often irredeemable in the sense that the bank will never redeem that bond. And whoever buys the bond will get the stated rate of interest as long as the bank continues to exist. So in such cases, let's say the price of the preference share is 95, expected dividend is 10 in perpetuity. So what is the cost? It is 10 by 95, 10.53. So this will be the cost in perpetuity. So which is lower after tax, cost of debt or cost of preference share? So obviously, since debt is a tax deductible, that is going to be better after tax. Now, in the case of equity capital, first thing to again remind ourselves is that it is not free of cost because there is an opportunity cost for the shareholder. So ordinary shareholders supply funds to the company in expectation of dividends and capital gains. The market price of the shares reflects the required return of the shareholder. And cost of equity is equal to the sum of the present value of the expected dividends. So remember, like when we were saying, we did this in the case of bonds. That same logic applies here also, theoretically. Obviously, the market moves in ways which sometimes are very unpredictable. But in theory, that same logic applies. That the cost of equity is the sum of present value of the expected dividends. Another aspect is the distinction between internal equity and external equity. So this is something which we had mentioned in an earlier lecture also. Internal equity is essentially the profits which are generated by the company itself. Whatever profits it generates and it retains, which it generates, doesn't pay as dividend, it retains, that is called internal equity. So this is a contribution to your funds which has come from your own profits, from your own efforts, from your business activities. So it's internal, as against an issue of shares, which would be external equity. So that's one thing to remember always. And now if you come to, we look at the first, let's say the simplest model for looking at the cost of equity in general. It will work for internal and external. So for an investor, the cost of retained earnings is the same as the opportunity cost of the retained earnings. If earnings are retained, then a dividend is not paid. If the dividend had been paid, the investor would have invested it. So he expects that by retaining it, the company will be able to give a return equal to his opportunity cost. See, the logic is very simple. You didn't give me a dividend. Had you given me a dividend, I would have taken that money and I would have invested it in some particular scheme, some company maybe, and I would have got a certain amount of return. So if you are not giving me dividend, the amount of return that I would have got by that alternative investment is the minimum amount of return which I expect you to earn within the company. Is this logic clear?
Yes, sir.
So the investor is foregoing the retained earnings and expects a return that is equal to what he could have earned in the market. The opportunity cost of the retained earnings is the required rate of return foregone by the investor. This concept of a required rate of return is actually that rate of return which he'll get in the alternative investment. So investor generally expects dividend. So when you buy shares, you are not only expecting dividends, you are also expecting to have growth. You're expecting some capital gain will also happen. In fact, most of us today who go into the stock market, we are least concerned about the dividends, practically speaking, more concerned about how much the share price is actually going to increase, because everyone is looking for a quick return. But let's take the theoretical, the investor in finance theory. He's expecting dividend and he's also expecting a capital gain from the investment. Now, the required rate of return of investor can be calculated using the dividend growth model. So how will it work? This KE subscript E, this is basically the cost of equity. So what will it be? See, the amount of dividend expected at the end of the FY, not the dividend paid last year. Whatever you are expecting, divided by the current market price of the equity share, plus the expected growth in the dividends. Now, if you were to reduce this to actual figures, let's say the current market price is 90, the amount you expect in the year ahead is 450, and you expect a growth of 8%. Then in that case, what is the cost of equity? It will be 450 divided by 90 plus 8%, which is equal to 13%. This is a very simple calculation showing you, and this is one of the first models which came out for determining the cost of equity. Now, there are some basic assumptions made in the model. The market price of the share is based on the expected dividends, that present value concept. See, the market price of the share is based on a calculation of the expected dividends over the years, over the next very long period of time. What is the total amount of money which I'll get? That is my market price. In the same way that we calculated the market price of a bond, that same calculation of discounting the expected, in the case of a bond, what did we do? We said that these are the coupon payments, the interest payments which will be made. We discounted them, and then we found that it gave us that exact rate. So the price is a function of the discounted values of the expected dividends. The other assumption is that dividend will grow at a constant rate. So if I'm assuming 8%, the assumption here is that dividend will continue to grow at 8%. So these are the two calculations, two assumptions which are made in this model, which may not always be there. But remember, these models are based on very stable conditions. And there are certain assumptions which will always be there, which will basically affect the way the model works. So that's one. Now, the model implies that if instead of retaining earnings, the company had distributed dividend to the shareholders, they could have invested it in shares at the market price and earned a return equal to the cost of equity. The same point which you are making here. So in this illustration, if I say that 13% is the cost here, then the opportunity cost for the investor is 13% or less, or otherwise you would not have invested here. Are you getting this, Anjali? See, it's a very theoretical thing, but basically it is giving you some idea of what cost of equity can be. Now, so if the company wants to retain earnings, it should earn at least 13%. This is the whole logic here. If it earns less than this, then it will not be doing good by the investor. Because you see, the investor, you by not giving him a dividend, you robbed him of the opportunity of investing that money. Okay. Now, let's take a case where the market price is a little different from the issue price. So the share is sold at a discount. That is, the selling price of the new share is less than the market price. Then the cost of external equity will be higher than the cost of internal equity. See how this works. For example, a rupees 100 share newly issued is sold to investors at rupees 95. So it's sold at a discount. Then the cost of external equity will be higher. How does this work? Cost of equity is equal to, this is the rule, right? This is how we're getting it. So if I assume that the expected dividend is 475, growth is 6%, then the cost of equity will work out to 10.75%. Now, if this is the internal equity, right? Because I am taking the full value of the share, 100. But if a 100 rupee share is sold for 95, then the calculation will have 95 in the denominator. So it's going to be 4.75 divided by 95 plus 6%, which means you're going to get 11%. So ultimately what you see is that if it is sold at a discount, then the cost of external equity will be higher. See, it's also clear now. You can look at it in a simple way, non-mathematical way. You are
Paytm example.
Huh?
Example, recent Paytm stuff.
Yes.
Paytm IPO.
IPO, yes. Sold at a discount. So basically, because you are giving dividends on 100 rupees, but the guy paid only 95 for it. So obviously the return which he will get will be higher. So if you sell something at a discount, then the cost of equity, the external equity, is going to be higher than the internal, had it been retained. Now, the point here is, the other thing will also be true. If you sell it at a premium, then what will happen is that the cost of external equity is going to go down. All you have to do is assume that you sell it for 105 or 110. If you do this, so Anjali, you can do that calculation on your own. 4.75 divided by, increase this. See, if the face value of the share is 100, if you increase it beyond 100, you will see that the rate will begin to go down. So that's something which you should remember. So the growth of dividend reflects in the share price in the form of capital appreciation. That is, increase in the price of the share. The market is supposed to capture this. Growth is given. How do we estimate G? So basically, what you're going to look at is the return on equity multiplied by the retention ratio. Retention ratio is what? If I make 100 rupees of profit and I give 50% as dividends and 50% is retained, then it is 50-50, 50% is my retention ratio. So it's just try to think about the share of the actual profits made which were retained by the company. So suppose the return on equity is 16%. If you reinvest the entire profits into the business without giving dividends and you assume the same ROE for the next year, then the growth will be 16%. But if you retain 50% of the profits, the growth will be less, as you have retained half the profits. In such a case, the growth will be 16% into 0.50 or 8%. See, the point which this being made here is essentially that when you pay out dividends, you have less funds at your disposal for expansion and for increasing your profits. So that is why when you pay out dividends, the growth may slow down. If there were definite business opportunities available, which required a capital investment, but you made dividends, you paid dividends, and the capital was not available for those investments, then in that case, the growth will slow down. So a very simple calculation here, just to bring home that point, that there is a cost to paying a dividend also. It's very possible that paying dividends, you have to pay the dividend, like you said, Anjali, that it's a matter of status, reputation. But at the same time, it's also possible that payment of dividends could rob you of the opportunity of expansion, growth, and increased future earnings. So if I'm not giving you money today, I will actually give you much more in the days to come. Okay. This was you can try and do, when I send this to you, you can try doing the simple calculation on your own. Now we come to, let's say, a more complex model, which is called the CAPM, the Capital Asset Pricing Model. Now, this model actually factors in the market itself. So, it's used to calculate the return on equity. It provides a method to determine the relationship between the return and the risk of an equity share. So it's factoring in both the return and the risk. See, in the case of the dividend distribution model, dividend growth model, what we saw was that there the risk factor is not taken into account. But this is a more complex model. What this does is, how does it calculate the risk? So it looks at the risk in relation to the performance of the company as compared with the market as a whole. So the whole market has a certain performance. What is the performance of your company in relation to the performance of the market? Now, the market may have, thousands of companies. How do we understand the market? So the market is represented by an index of shares, such as the Sensex or the NSE, Nifty. So if you look at, just Google and see, you'll see that the Nifty has a value which moves up and down based on the prices of the shares which comprise the Nifty or the BSE. So the question to ask to understand risk is, does the share of a company which you're interested in move in the same direction as the index, or is it moving in opposing directions, or is it moving less than the market moves? What exactly is happening? So the relationship between the way the share moves over a period of time and the way the market moves in the same period, this relationship is called the beta. So the first thing here is, if I am going to do CAPM, I first have to understand the concept of beta. And what is beta? See, a very simple way of understanding beta would be like this. Beta is the risk of the market as a whole. Okay, so the risk of the market is treated as 1. I give it a number. So I say the market risk is 1. So what is the market? So let's say there are about 7,400 companies listed in the BSE and NSE, but I am basically capturing the performance of these 7,400 companies through my index, either the BSE, where there'll be about 30 stocks, or the Nifty, where you will have 50 stocks, the Nifty 50. So basically, these indices that we have, Sensex and Nifty, they are representative of the market. Why? Because the bulk of trading is done in these companies. The companies which you choose are those with the highest capitalization. That means the largest number of shares floating in the market belong to these companies. So you basically look at the way trading has actually occurred in these particular shares and where the price of these shares have moved. And you use this as a proxy for the market as a whole. Is this point clear? Anjali, are you getting this? Clear, na? So the base value of the Sensex was 100 on 1st April 1979. Today it is more than 57,000. I'm not sure about this. Lokesh, am I correct here or is it less?
No, sir. It is around 55, 56 only now.
It's about 55, 56. So depending on the day you take it, it will be different.
Yes, sir. It has shrunk in the recent days very much.
So basically, there is a, this represents the sort of growth that you will have. So if you, let's say you take the growth in the Sensex on a year-to-year basis, it can be measured like this. For example, on 31st December 2020, the Sensex had a value of 47,896. 1 year later, 31st December 2021, it was 57,000 plus. Yearly growth is about 19%. So if I want to say growth of the market, I will basically say this, that the growth of the market is 19%. So the share price of an individual company also goes down on a daily basis. I can find out the amount of growth that occurred in the shares of that particular company's shares in 1 year. So if I say that the growth of the Sensex is 19, what was the growth in the case of the company shares? If it's exactly 19, then it's exactly moving in line with the market. But if it is different, it will basically be, slightly different. So it could vary. Here you come to a statistical concept. We won't be getting into too much detail, but just look at the way it's calculated. So depending on, whether, as far as Anjali is concerned, what further studies you do, whether you actually, if you go into a field which will require statistics, you'll be doing a lot of, let's say, work on this. But basic covariance, let's just try to understand it. So one point we made is that the shares of price of a company move up and down on a daily basis. That also happens with the market. What is the relationship between these two? The movement of the company shares and the movement of the market shares. So scenario one, market is going up, the share growth is also going up. It's going in the same direction. This is called a positive covariance. So they are varying in the same direction. The variation is that change, in the price of the shares or change in the price of the index. Both are happening in the same direction. So it's a positive covariance. Another could be that when the Sensex moves up, the share price of the company moves down. It's going in opposite direction. So it's opposite covariance. Now, how do we calculate covariance? See, let's be very clear about this. I'm not expecting you to do covariance as a, I won't be giving you any assignments on covariance. But it's good to understand how we got that beta. So when we said that the beta is this, how exactly did we end up with that figure? So let's make some simple assumptions here. So X subscript I is a given X value in a data set. XM is the average of the different values. So let's say I take a company and I take its growth rate over 5 years. So that would be X subscript I, and XM would be the average growth of the company for 5 years. Similarly, Y value in the data set that corresponds with X, YM, the mean or average of the Y values, N, the number of data points. Don't get disheartened by all that. It's when you see the example, it'll be pretty simple. But at a very simple, thumb rule type of calculation, just for understanding that this whole covariance thing. Example, if the market return is 10% per year and the return of the stock is 20% per year, the beta of the stock is 2. Simple. Market is 10, this is moving at double the market, so the beta is 2. If the return of the stock is 10%, the beta would have been 1. If the return of the stock is minus 10%, the beta would have been minus 1. So essentially, it's, just to understand the beta, you can look at it like this. If you already know these things, what is the market return, what is the return of the stock, you can actually calculate it as simply as this. It won't be very accurate, but it's a back of the envelope method to give you an idea about what is happening. Now, if we were to do this in a very formal way, calculating the beta, so it will be something like this. These are my years, 1, 2, 3, 4, 5. In this column here, this is the market return. Here I'm using this return of the market RM subscript. So the market return in let's say last year was 18.6. The year before was minus 16.5. Before that was 63.83. Before that was minus 20.65. And before that was minus 17.87. Now I take a company, an imaginary company, return, I call it Ashok Paints, and I look at the returns of this company. What was the return of the share price? What did the share price move in the first year? 23.46. Before that, it was actually down, minus 36, plus 52, minus 7, minus 12. So as you can see, in the years in which the market has a positive figure, these chaps also have a positive figure. That is very easily evident. But some places it's higher than the market. Some places it's lower. 63, 52. 18, higher, 23. The loss is much higher here. The loss is lower here. So year to year, the variations are different between the market and the company. So what we do is we average this. So to do that, what we're doing is we will take these figures and place them here. You get the average of the market return, and you find that on an average over the 5 years, the growth of the market was 5.4 or 5.5. The growth of Ashok Paints was 3.9. So one thing is very clear. Is this a positive covariance or a negative covariance here? It's moving in the same direction. Both are plus. So it's positive. Now to calculate my beta, there are a number of steps. First step is deviation of the return from the average return. So 18.6, the average is 5.4. In year 1, the return was 18.6. So what is the deviation? 18.6 minus 5.4, I get 13.12. Minus 16.5 and 5.482, what is the difference? It's minus 21, because this is a minus figure, this is a plus figure. So you're adding. 63 and 5, it's a 58% variation. So these are essentially to what extent did the market return differ from its average? How much of a distance was there between the average return over the 5 years and the return in this year? Here, I look at the same thing for the company. So look at the company's average was 3.9. In year 1, it had a return of 23.46. So here I'm writing 23.46 minus 3.9, getting 19.51. And similarly, minus 36 plus 3.946 here, I'll get 40.8. Here, 52 and 3, 48, minus 7, 3, 11, minus 12 and 3, 16. I get this. Now you multiply these two. You multiply these two, you will get this column. And you total all this, you get this. This you divide by 5, you get a covariance of 933.26. Here you make a square of the market deviations. That means these are the market deviation, means deviation from the average. I have my market return for 1 year here. I have the average here. The deviation from this, the difference from this is noted here. I square this, 13.12 squared, I get 172. Minus 36 squared, 483, etc. I do the whole thing. I'll end up with 5288. Now that I have this, all that I'm doing is I'm dividing 5288 by 5, dividing 466 by 5, and what I get is the beta. 933 by 1057. So covariance divided by the average of this, you get the beta of 0.88. Now, if you have the beta, you can actually work out the actual CAPM thing. Now, the point is, I showed this to you in a manual way so that you understand how this actually happens. In practice, it will be possible for you to practically Google this, and find out what the beta of the market is. If you have some inputs, you'll find it out. So to get the beta, we divide the covariance of the stock with the market with the square of the deviations of the market itself. So we find that the beta is 0.88. Now, the movement of the share is compared with the movement of the market. The beta of the market is 1. The beta of Ashok Paints is 0.88. The share prices of Ashok Paints move in the same direction as the market to the extent of 88%. This is what this tells you. So let's forget about everything else. Are you just understanding this point here? If I say that the beta of Ashok Paints is 0.88, one thing which you see is that it is positive. Positive covariance is happening. It's a plus figure. If the market goes up by 1, Ashok Paints is going to go up by 0.88. This is on the basis of the 5-year performance of Ashok Paints and the market. So basically, now that I know this, I can calculate the cost of equity, keeping in view this part. This is the risk. So the market was moving at 1. I didn't move with the market. I moved less than the market. Okay, so now if I have that, I can calculate my return. Now, what are the different variables in calculating it? First is, of course, I want to know the required rate. What is my return? This is the first one. Earnings are subscript I, expected return of investment, risk-free rate, the beta. If you get this, it's very easy for you to calculate. So essentially, what is happening is the market return is to be calculated on an average basis. That we've done. The risk-free rate will be the rate on government bonds. So you take the rate on government bonds for the last 5 years. That will give you the risk-free rate. Why is it a risk-free rate? Anyone? Why would we consider this a risk-free rate? The government bonds?
Sir, they will definitely pay, sir.
They will definitely pay.
Yes.
So it's a sovereign thing. So they will always pay.
Definitely pay. There is no chance of liquidating of the company.
Yeah. So there is definitely no risk here. So essentially, since the risk in investing in a company is higher than, it has to be higher than the risk-free rate. Since the risk is higher, the return which you expect will have to be higher than the risk-free rate. Now, the market return, let's say, is 12. That means if I were to average it and I find that the market return is 12, risk-free rate is 5, then the risk premium is 7. 12 minus 5 is 7. The beta is 0.88. So beta multiplied by the risk premium is 6.16. So the required rate is basically 6.16 plus 5. So the risk premium of 7 is multiplied by the beta. And that gives me a lower, the expectations from the company are lower. No? Because when the market performs 1, the company gets only 0.88. Therefore, if I get my risk premium, how do I get the risk premium? I get the market return, I reduce the risk-free rate. Market return is 12, risk-free rate is 5. I get a risk premium of 7. And then I multiply this 7 by the beta, I get 6.16. Add the risk-free rate to 6.16, and you get your required rate of 11.16, which basically means this is the cost of equity for the company as per the CAPM. Okay, so this is essentially about the CAPM. So just think about this a little. These are ways of looking at understanding cost of equity, cost of debt, both we've done today. Have a look at it. We'll revise this again a little tomorrow and then proceed to the next part. Okay, so I hope it wasn't very boring, today's lecture. Thank you, both of you, for staying on. And when you guys are there, then I feel encouraged to do it properly. If you're not there, then it becomes a problem. And I understand there will be situations when you will not be here. But I always like you to know that I appreciate the fact that you're there and listening and interacting. That's all. Okay then. Good night.
Good night, sir.